In this lesson, we'll introduce the concept of fixed income securities, yield to maturity, and theories of interest rate term structure. First, we'll discuss the common fixed income securities like government bonds and private corporate bonds and their stylized properties. Next, we'll understand their valuation. We'll then discuss a very important property of bonds, that is yield to maturity, YTM, and the role of term structure of interest rates in determining YTM, that is yield to maturity. Next, we'll discuss the concept of spot and forward rates and their relationships. We'll also discuss the law of one price and its implication for bond prices. Lastly, we'll discuss various theories explaining the term structure of interest rates. In this video, we'll introduce fixed income securities like bonds and debentures. Bonds and debentures are simple debt instruments for borrowing. These are employed to borrow for short, medium, and long-term loans. The long-term loan could be for more than 1 year, like 3 to 8 years, and so on. Even there are bonds for 20 years also. The very short-term instruments are traded in money markets. So these are also called money market instruments for extremely short-term borrowings like T-bills, government securities, repos and reverse repos, certificates of deposits, LIBOR, MIBOR. These are traded even for overnight, daily, and so on, those kind of short horizons. In this discussion, in this lesson, our focus will be on bonds and debentures that are for medium to long term instrument. Here, the issuer of the instrument has borrowed the money. So it's a simple loan where one party has borrowed the money and agreed to pay a particular stream of cash flows. For example, typically these are called interest. In the context of bonds, these would be called coupons and so on. Like we said, the interest in the case of bond is called coupon. And globally, there are four kinds of bond markets, starting with government bond market, corporate bond markets, mortgage bonds that is very developed in US. You can associate with the mortgage crisis in US that happened. Municipal bond markets is also there. A parallel in the Indian context would be like bonds issued by state authority. So in India, there's no sort of parallel to specifically to municipal bond which are issued in US. In India, you can think of state issued bonds. In India, we have also bonds from PSUs like railway bonds and so on. If you look at Indian bond markets, it is less developed. Predominantly, it is government bonds that are being traded. And for private corporate bonds, it is only very high AAA rated kind of bonds that get some audience. Low rated bonds, even triple B kind of bonds do not get much audience in Indian bond market. So they have to rely on bank borrowings. Let us talk about government security markets or G6. These are considered to be risk free because there is very less risk of default. For example, if you consider Indian government borrowing in rupee loans, then it required, if required, it can print also a lot of rupee, although it will lead to inflation and some adverse consequences. But still, this is one major reason why government borrowing are risk free. Now, globally and in India also, G6 are the largest and most liquid markets, particularly because of the credit strength of the government and the belief and creditworthiness of it. A very well functioning GSEC market is very important first for setting the interest rate in an economy, creating the interest rate environment, and providing benchmark for risk-free interest rates. So GSEC market trading results in price discovery of risk-free rates, and these risk-free rates act as sort of starting or guiding point for riskier instruments also. So you can add on these risk-free benchmarks, you can add sort of risk premia to arrive at a riskier instruments that like corporate bonds. Now, generally, these are government securities are investment grade, like triple B category and above, with very low default risk. So, if government of a country like India, if it is rated well, then instruments is also likely to be rated well. And particularly if the security is issued in the currency which the government can issue, then obviously there is a very low chance of default, and therefore it has very minimal default risk. Now, in India, these G-SECs are very important. They are used as collateral in many markets. For example, in money market, these are heavily used as collaterals for borrowing, lending money. And they also meet your statutory liquidity requirements, particularly those set by RBI. So RBI often set instead of cap some liquid cash capital, you can also use government securities as permitted by RBI. Coming to corporate bonds, corporate bonds are issued by corporations which may default on their obligations. So there is a credit risk. They are often rated from AAA, AA, and so on. Triple B is the minimum investment grade category. Anything lower than triple B rating is a non-investment grade. and because there is a risk of default or delay in payment of principal coupon, so there is a risk, credit risk and default risk. Now, in India, corporate bond market is much smaller than government bond market. This is also something has to do with our own credit framework and credit assessment capacity, which is much lower than developed market like those in Europe and UK. So that is why most of the audience is given to government bond market, and private corporates, unless until they are very heavily rated like AAA, they do not get as much subscription. Corporate bond comes into wide ranges from investment grade triple B and above to default. There are low rated bonds that are rated below triple B and so on, and then there are high rated bonds. These low rated bonds have high default potential, or there is a possibility of delay in their obligations, may not meet their repayment obligations of coupon and principal payment. While high rated bonds, there's a high chance that they will meet their obligations, and that is why low rated bonds generally, in order to get subscribed, they have to offer higher yields. So because there's a risk, so they offer higher return or yield, while high rated bond, they offer relatively low yield because they are good and creditworthy. To summarize, in this video, we introduced fixed income security instruments like bonds. We also discussed different types of bonds, including government securities and corporate bonds. And we discussed how the risk dynamics results in different yields or interest rate in these bonds. In this video, we'll understand the concept of term structure of interest rates. And with the help of this concept, we'll also try to introduce yield to maturity concept. One can think of term structure of interest rate as a relationship between short-term and long-term interest rate in an economy. For example, you can simply visualize it. Let's think of x-axis as time period and y-axis as interest rate. If you plot the interest rates over different maturity, for example, you can think of different bonds or instruments traded, their maturity here and interest rate that is offered on the y-axis. You can plot this, and this relationship or depiction of this graph would be called term structure of interest rate. For example, here you can see a rising term structure, which suggests that as time passes, interest rates are rising, or market is anticipating rising interest rates in future, while a declining market would suggest that market is anticipating falling interest rates in future. Let us understand this with a simple example. Suppose there is a instrument like loan or bond that pays $1 at the year end one, and the spot interest rate that is applied on this cash flow is R1. So if I want to calculate the present value of this instrument with cash flow discounting concept, the value would be 1 upon 1 plus R1, because R1 is the interest rate. So the discounting factor would be 1 by 1 plus R1. There's another cash flow or another bond at the end of year two, which also pays $1. But because of term structure of interest rate, the second year spot rate is R2. Then the second cash flow, that is $1 at the end of year two, will be discounted at 1 by 1 plus R2 raised to the power 2, because it is applied on second year. So the first year cash flow is discounted at first year spot. Second year cash flow is discounted at second year spot. Generally in textbook and previous discussions, we have been assuming the same discount rate for all the cash flows. But because of this term structure of interest rate, whether rising or falling, these discount rates and spot rates differ across the maturity or timings of the cash flow. Let's put some numbers here. Think of a bond that has only two cash flows, $1 at the year 1 and 2, and the appropriate spot rates are 3% and 4% for years 1 and 2 respectively. Then we can easily calculate the present value of this loan or bond in this fashion. So first cash flow $1 discounted by 1 plus R1, that is 3%, and second divided by 1 plus R2 raised to power 2, which is 4%. We get the value of 1.895. Now, we know there's something called internal rate of return concept, which determines what is the single discount rate or return on an instrument or return of a project. Think of that discount rate, a single discount rate that will result in this present value of this bond. What it means is that if I find a rate called Y, at which if these cash flows are discounted 1, and it should result in 1.895, the same present value that it has given the term structure now. This interest rate is also called, it is parallel to internal rate of return concept, and in bond parlance, the same concept is called yield to maturity. So if we solve this equation, we'll get the value of yield to maturity as 3.66%, which suggests that if I hold this instrument to maturity, if I buy it today and hold this to maturity, the return that I'm getting is 3.66%, which was expected because the lower side is 3 and higher side 4. So that some kind of weighted average would be in between, which is 3.66%. So this is called your yield to maturity. And this is derived from the term structure of spot rate. So the term structure we had 3% for year one, 4% for year two, and so on. Using these cash discount rates, we discounted the cash flows and derived YTM. Now this YTM relies on law of one price, which means that investors discount and value the risk-free dollar in an identical manner, whether it is from bond A, B, or C, or in more broader terms, if $2 coming from whatever sources, if they have the same risk, then they should command a same price also. So now that we have understood the term structure of interest rate and we have also introduced yield to maturity concept, in the next video, we'll discuss yield to maturity concept in more detail. In this video, we'll discuss the concept of yield to maturity or YTM in more detail. Yield to maturity or YTM is the internal rate of return on a financial instrument like bond. If somebody holds it to maturity, this would be the rate that the investor would get. Let's consider a 3-year bond with an annual coupon of 100 rupees and principal payment of 1000. Suppose its current price is 900. Now, one question that we should try and think that why the current price is lower than the principal payment, but let's see. So there's annual coupon of 100 and current price is 900. And the way we have defined YTM or yield to maturity is the rate that equates its current price, which is 900, to the present value of all the cash flows. So in order to get the present value, we need to discount each of these cash flows, 100 in first year, 100 in second year, and 100 coupon plus 1000 principal in third year at YTM. So first year 1 plus YTM, second year 1 plus YTM raised to power 2, and third year 1 plus YTM raised to power 3. And this should come at 900 if this identity has to hold. First thing that should be immediately become clear from this formula is that YTM is some kind of complex weight of term structure of interest rate. For example, you have different spot rates for 1 year maturity, second year maturity, and so on. Recall we looked at the term structure which was rising in nature, and you have different maturities, different interest rate. This YTM becomes some kind of complex weighted average of those term structure of interest rates. The second thing, there's a declining relationship between yield and price. So as the yield YTM increases, the price declines. So these two are very fundamental. Later on, we'll see the third property that when the maturity of instrument increases, it becomes more sensitive to changes in yield, but that we'll see later. So let us come back to that formula again. So this was the identity that we are trying to solve, and solving this, you can solve it in Excel or any tool that you may desire. You get a YTM or yield to maturity of 14.3%. So effectively, this is the return if I buy this bond at 900 today and get all those cash flows, 100 coupon and 1000 principal, this would be my return. For a more generic case, we can summarize this expression as price equal to summation t equal to 1 to TCT, which are cash flows at time t, by 1 plus YTM raised to power t. So this is more generic impression. Now, one important aspect here is the frequency of coupon payment. Let's understand why. Suppose in the previous case, instead of annual coupon, we get semi-annual coupon payments. In that case, every 6 months we'll get not 100 but 50 rupees, which means we are getting money in advance. And instead of 3 coupon payments, we'll have 6 coupon payments, 50 every 6 months. Earlier we had 100 coupon payments every 3 years. Now the discounting would also change because each of these cash flows would be discounted at YTM by 2 for first 6 months, then YTM by 2 raised to power 2, and so on. This is simple compounding aspect. Now notice that you are getting your money much earlier in advance, and this change has happened. Earlier you were getting 100 rupees in 1 year. Now you are getting 50 rupees in 6 months. You can put that 650 additional to use for the remaining 6 months. That means you can earn interest on interest, and therefore the YTM effectively should rise. Let's see how much. So when we solve for this, we get YTM of 14.2. What does it indicate? It indicates a YTM by 2 equal to 14.2 by 2. Now, looking at this expression, you may be a little surprised that earlier we said our effective return should rise, but now we are saying it is lower. No, this is misleading. So this is called quoted rate. This is quoted rates. The actual rate for 6 monthly compounding, because now we are doing 6 monthly compounding, the actual rate is YTM by 2, which is 14.2 by 2. Now, what is the effective rate? If this is quoted rate, what is the effective rate? So this what we call as effective annual yield. To calculate that effective annual yield, we need to remember that 6 monthly yield was 7.1% that we were getting. In order to convert this 6 monthly yield to effective annual yield, we need to do 1 plus YTM by 2 raised to the power 2, which is this, minus 1, which is 14.7, which is greater than 14.3. So this is not the effective yield you are getting. This is kind of quoted yield. The actual yield that you are getting is for 6 monthly compounding, which is YTM by 2, and converting into effective annual yield, it becomes 14.7%, which is greater than the annual. When the compounding frequency was annual, we are getting 14.3%. So this is higher than that. To summarize, in this video, we discussed the concept of yield to maturity in great detail. We noted that if the coupon frequency increases because we are getting our money earlier in time, the effective yield also increases. In this video, we'll try to understand the concept of yield to maturity, but with an example where there's no annual compounding but monthly compounding. Let's have a look at this example. Consider a 30-year monthly coupon paying bond. Now, this is a unique bond, so there are no principal payments, and the monthly coupon payments amount to 8,482 rupees or dollars. The bond is selling at 1 million or 10 lakh rupees or dollars. Let us try to calculate the YTM. Now, one way to calculate is to apply the formula of annuity. Recall the annuity formula that we studied earlier, 1 minus 1 upon plus R raised to the power T. This was the typical annuity formula because this is monthly coupon paying bond. So coupon C will be divided by 12, YTM will be divided by 12, and here the same will happen to this formula, YTM by 12, and total time periods are 12 into T, which is 360. So if you apply this formula, the PV should come to about 10 lakh rupees. If you solve YTM here, we should get the yield. Now, another way to solve this expression is to use this simple, which generally I prefer to do in Excel, which is more sort of gives an idea of what is happening. So you put in Excel, you put the first cash flow as 8482 in the first cell, second cell 8482, and you keep on filling the cells up till 360, 8482. Now, the YTM that discounts this and results in a price of 10 lakh or 1 million is the right YTM. Now in Excel, you can apply this simple formula of IRR, put all the cash flows at the 0th cash flow, put minus 10 million and select all these cells, you'll get the correct YTM. So when we do that, we solve for it, we get a value of 9.6%. Second step is to calculate effective annual yield. Please note that this is YTM for or the quoted rate for the full year. The monthly rate, which is the actual rate that is being applied, is 9.6.12, which is 0.8%. Now, this 0.8% is what compounding. It is the amount that is compounding, the interest that is compounding. So it will something like 0.8% upon 12 raised to the power 12 and minus 1. This is your effective annual yield. So effective annual yield can be calculated as approximately 10%, which we get here. So to summarize, in this example, we calculated YTM of a coupon paying bond, a slightly niche bond where there are no principal payments with a monthly compounding. We noted that the annual number that we got after solving this expression was the quoted rate. So the effective yield was much higher than this. And also you need to remember bond markets are generally large ticket size markets. So even this gap of 10% minus 9.6, which is 0.4%, if you think in terms of billions of dollars of ticket sizes or the transaction amounts, even the small amount can result in huge difference in terms of money. In this video, we'll have a deeper look at the yield to maturity concept. More specifically, we'll try to understand one slightly typical issue, which is the reinvestment of coupons. The principle of discounting create a very basic conceptual issue with YTM. It assumes that all the coupons that are received before maturity are assumed to be reinvested at the respective specific YTM of each bond up till the horizon that is bond maturity. Now, understand that if two or three more bonds, their YTMs are calculated and they come out to be different, the assumption inherent in this calculation is that individual coupons and other cash flows received in between are reinvested at this specific YTM of this bond. And therefore, YTM of different instruments is not exactly comparable for this very reason. Let us understand this issue in more detail with this example. Consider two bonds A and B. Their coupons 10%, 3%. Their principal 100, price different 138.9, 70.22. Their maturity 15 and 16 years. Annual coupon payments. Now, given this different cash flow profile of these bonds, one may expect their yield to maturity to be different. For example, for bond A, the yield to maturity comes out to be 6. For bond B, 6.1%. However, the individual respective calculation of this yield to maturity number assumes that all the cash flows that are received before maturity for bond A are reinvested at 6%, the respective YTM, and for bond B at 6.1%. Now, common sense would suggest that different organizations, they may have different risk profiles, but their investments yield same returns. For example, if both of these organizations invest some amount in FD, SBI FD or some other bank FD for 5 years, or some other bond or some other security, equity as well, the return that we would get would be same and not differ. And therefore, this assumption of same reinvestment at same return makes them not comparable. Now, this is in very much contrast with equity portfolios. When we were calculating equity portfolios, the assumption was that return of the portfolio was weighted average of individual security returns. For example, if there are n securities with respective returns of R1 bar, R2 bar, and so on up till Rn bar, and weights invested W1, W2, and so on up till Wn, we said that the portfolio return or expected return RP bar or actual return RP would be weighted average Wi Ri bar summation I equal to 1 to n, or actual return would be I equal to 1 to n WIRI. This would hold for respective portfolio return. However, in the same way, we cannot say that for bond, the yield to maturity of the bond portfolio would be weighted average of individual bonds. For the precise reason that there is an assumption of reinvestment, that coupons are reinvested at the same return as YTM of the respective bond. We'll try to explore and understand this issue in more detail with the help of simple example in the next video. In this video, we'll try to explore and understand the comparability of yield to maturity across different bonds with a simple example. Let us consider three bonds A, B, and C. Their profiles are shown here. For example, A is currently selling at price of 100, year one cash flow of 15, and a coupon of 100. Its yield to maturity is 15%. B with coupon of 6, its yield to maturity is 6%. C shown here, its yield to maturity 12.35%. The cash flow profiles are also shown. In addition, we also combine security A and B, and these are their cash flows. We also compute their yields of the combined portfolios A plus B, B plus C, and A plus C. Now, if you look at the combination B plus C, let us explore it further. The total investment or total price that I pay for buying these two bonds is 192. Their profiles are given. Now, if you want to compute similar to equity portfolio, their yield in a weighted average manner, what we need to do is recognize that there are two bonds. The first bond is bond B with the 6% yield, and the total weight in this particular bond is 100 upon 192. 192 is the overall investment, 100 is the investment in bond B. Similarly, for bond C, the yield is 12.35%. The weight invested is 92, overall investment is 92. So our total 9.04% is the weighted average yield of this portfolio. However, when you calculate the yield to maturity of this A plus B portfolio, which is this can be computed using 192 equal to 15 upon 1 plus YTM, 115 upon 1 plus YTM raised to power 2, and 109 upon 1 plus YTM raised to power 3, which is discounting these three cash flows at the YTM. You get YTM as 9.65, which is different from this 9.04. What does it indicate? This shows that the YTM of this combined portfolio is not the same as weighted average of individual securities, and this applies to other combinations such as A plus B, B plus C, and A plus C as well. Though in some cases it may be same, but this is not a generic or sort of rule. So the rule is most likely they would be different. This is a very important concept that we need to understand, and that is why while comparing YTM across bond is not fair because of this reinvestment assumption. And finally, if you have invested in such combination, it is better to calculate their YTM separately through this approach rather than using some kind of weighted average. In closing, there is also something called current yield of a bond. This is simply annualized coupon payment. So whatever is the annual coupon, if it is semi-annual, then you multiply it by 2, divide by the current price. So for example, if a bond has a price of 100 and pays a semi-annual coupon of 50, the total annualized current yield is 15 to 2 divided by 100, which is 12.5%. It gives you some idea how much that bond is yielding per dollar or per rupee investment. So for example, each 100 rupees, this bond is yielding 12.5%. Suppose this yield is higher than the current interest rates prevailing in the market or current interest rate for the risk of this bond. That means this bond is offering a slightly higher yield. It's a kind of thumb rule or heuristic for you to judge the quality of a bond, whether it is undervalued or overvalued. Without much analysis, you simply divide coupon by price and get a fair idea whether it is a sort of undervalued or overvalued bond and so on. To summarize, in this video, we understood how to compute yield to maturity of a bond portfolio. We noted that it is very different from equity portfolio as the yield to maturity calculation in the bond assumes reinvestment assumption. They cannot be used as a weighted average of individual bond in a manner that we do for equity portfolios. We also examined the concept of current yield, which is a sort of thumb rule or a quick to calculate, easy to calculate measure to understand whether a bond is overvalued or undervalued, or whether it is offering a return or the coupon which is higher than expected return or lower than that. In this video, we'll try to understand the concept of spot rates and how to calculate spot rates with the help of government securities, more specifically STRIPS or separately registered traded interest and principal instruments. So consider a pure discount bond with an investment of 970. That means its price today is 970 and the principal amount that one gets after 6 months is 1000. What it means that some original bond with multiple coupons happening at 6 months, 12 months and so on would be separated. Principal amount would be separated and separately sold. So the remaining, this particular cash flow that happened 6 months after, when it is sold and traded in the market called STRIP, separate trading or registered interest and principal, is selling at 970. It is offering 1000 after 6 months. Now, the return that this bond is offering is called spot rate. So either you can say this is the return on this bond or separately traded coupon, or this is the rate at which, if discounted, this 1000 inflow is discounted, one should get a price of 970. So one way to express this in the discounting form, I can write as 1000 upon 1 plus S 6 month upon 2 equal to 970, or this form. Now please note this 6 month is a quoted annual rate. So S 6 month is a quoted annual rate. To get the real discounting rate, one needs to divide it by 2. So this S 6 months is a abbreviation for quoted annual rate. If you have for different maturities, 1 year, 2 year, 3 year, 4 year, 5 year, for each of the maturities, if you have respective spot rates and you plot them, this in the bond parlance, these spot rates would be called the yield of those bonds. So if these are individual strips for 1 year, 2 year, 3 year maturity, single cash flows, the yield on these cash flows would be spot rates only. So there is a 3 years payment which has a yield of some Y. This is nothing but spot rate for 3 years. So if you plot these spot rates or the yields on these strips, these are government securities, you get the term structure of interest rate. This spot rates on strips have very significant meaning. They are very important in setting benchmark in bond markets, particularly the risk-free benchmark curve. Suppose you observe certain strips traded for six month, for example, 6 month, 12 month, 18 month, 24 month, and so on. So you have different maturity strips, their price, and the respective cash flow happening available with you. In markets, you do not observe spot rates directly. What you observe is these strips, their current prices, and the cash flows associated with them. You can back calculate interest rate to generate the term structure. So for example, in this particular case, I have the price and I have the cash flow occurring after 6 months, 1000 rupees. I have the price today, 970.87. If I solve for it, I get the spot rate for 6 months as 6%. In a similar manner, for other maturities like 12 months, 18 months, and so on, using the cash flow occurring after at the end of maturity of this instrument and price today, I can back calculate these respective quoted annual rates. So these are quoted rates. If you want to get the actual thing, you have to divide by 2. So divided by 2, you get the 6 monthly period rate, but the actual annual quoted rate is this one. Now in this shape, this would be called term structure of interest rate. So for example, if I plot it with its maturity of 6 months, 12 months, 18 months, and so on, the shape would be something like this. So this is 6%. And finally, after 36 months, this is 11%. So it gives me an impression that the term structure of interest rate is rising. So that is why these spot rates are very important. They give us term structure of interest rate, which sets the benchmark for interest rate in bond market. And any such risk-free instrument can be discounted. For example, if you are getting a cash flow after 6 months, if it is risk-free, government security, it should be discounted at this. This is called law of one price. So if it has same risk, a cash flow occurring after 6 months, it should be discounted at 6%, whether it is bond A, B, or C. Similarly, if it is happening after 1 year, it should be discounted at 7%, and so on. So that's why the spot rate and the respective term structure of interest rate generated from strips is very important. In this video, we'll try to understand the forward rates with the help of a simple example. Forward rates are different from spot rates in a manner that, let us say, date of commitment is today t equal to 0. The rate that is booked is in future. For example, this F12 is the rate booked for lending and borrowing from period 1 to 2, but the time of booking is today, while the rate for lending and borrowing amounts is in future from period 1 to 2. Similarly, let's say F1 to 3. This is the rate that is booked for period 1 to 3 for lending and borrowing purposes at today. Similarly, you can think of F23 for lending and borrowing from period 2 to 3, or 1 to 5, F15 for lending and borrowing over the period 1 to 5, but the contract or the booking is made today itself. Let us take one example. Suppose I commit today to lend 924.56 rupees or dollars 6 months from today, not today, but 6 months from today, and receive it back in 18 months. That is over a period of 1 year, 6 months to 18 months, which is the overall period of 1 year, 12 months. So now I want to compute the interest rate, the forward rate as 6 to 18 in an annualized manner, assuming that compounding is 6 monthly. So the 6 monthly rate is F6 18 divided by 2, wherein F6 to 18 is the annual quoted or annualized version of rate. So based on simple compounding process, 924.56 into 1 plus 6 to 18 month by 2 raised to the power 2 should be 1000. Or in other words, since we are getting 1000 rupees after the 12 month of lending borrowing period, the discounted value F6 to 18 month divided by 2 raised to the power 2, it should be this should be 924.56. So this is the typical interpretation of forward rate, and that is how it differs from the spot rate, which is booked today for a lending borrowing period starting from today, while forward rate is booked today but for a lending borrowing period starting sometime in future. With the help of an arbitrage argument, we'll try to understand the relationship between spot and forward rates. Let us provide the background to this problem. We have 2 period spot rate S02. That means we commit for 2 period lending borrowing. One period here is, let's say, 6 months. So for 1 year, that is 2 periods of 6 months, we commit whether lending or borrowing, we get a rate of S02. If you commit today for a 6 month period, you get a rate of S01, and the forward rate is F12. What is this rate? I commit today to lend or borrow from period 1 to 2. Now let's consider two positions. First, let us consider investing money in S02. Now, if you invest in S02 for 1 year, that is 2 6 monthly period, you are entitled for this return. Suppose you have invested $1, so you are entitled for this. The other way to achieve the same position is to invest in this S01 today, commit this S01, and also at the same time today itself book F12 for rolling over this position from 6 to 12 months. That means I'm committing my money for 1 year at first 6 months S01 upon 2, because 6 monthly compounding or 6 monthly investments are considered, and S01 is annualized rate. The second, when I roll this position over, I get F12 divided by 2. So this is effective rate for $1 invested. By the arbitrage argument, both of these positions should result in same outcome. For example, this identity should be obtained. Why? Suppose this identity is not true. Then in that case, there is a position for arbitrage. Let's discuss that arbitrage argument. Suppose this F12 is relatively lower than the previous equality, which means 1 plus S02 upon raised power 2 is greater than 1 plus S01 upon 2 into. Now there can be two reasons. Either F12 is relatively lower or S01 is relatively lower. Any one of them can be the case. But then there's a possibility to make an arbitrage argument. Suppose this side is lower, this leg is lower. Then I can invest in S naught 2. I can invest in S naught 2. At the end of the period, I'll get this money, which is 1 plus S naught 2 by 2 raised to the power 2. At the end of the period, I'll end up with this. However, at the same time at t equal to 0, first I borrow S at S naught 1 rate and I roll over my borrowing at F12 by period 2, so that by end of the 1 year, that is 2 6 monthly periods, my repayment obligations amount to this amount. And like we said that this entity is smaller than this because the S naught 2 rate was greater. There is an arbitrage argument by investing in this position and taking a short position here, that is borrowing at these rates. By short position we mean borrowing here and investing or lending here. Conversely, if opposite it is true, if S naught 2 is smaller, then we can borrow at this rate and invest our position for 1 year using this channel. So overall, there is an arbitrage opportunity. Basis this arbitrage opportunity, as more and more arbitrages will come into picture, naturally this identity will hold. So if one is relatively higher than other, this arbitrage demand supply for borrowing and lending will put them together. Similarly, let's suppose think of 3 period horizon. So for 3 period horizon, there are multiple ways to do investing. For example, you can invest for 3 periods as S03, or you can invest for 2 periods and also at the same time commit today to invest from 2 to 3 using this forward rate. So similar way, you can consider many such forward rate configurations, and by that argument, all such forward rates have to be in equilibrium with spot rate. What essentially it means is that all those forward rates that we saw in this diagram, multiple such forward rates possible, all of them have to be in line with different spot rates. So the entire structure of spot and forward rates have to be in equilibrium with this arbitrage argument. Lastly, let us understand how does it affect in terms of calculations. Recall in the previous example, we calculated the spot rate and the term structure of spot rates like this. Now we can, using these spot rates, we can calculate the forward rates. For example, F1 to 2 with the arbitrage arguments. Recall our arbitrage argument that 1 plus S naught 2 divided by 2 raised to power 2 is equal to 1 plus S naught 1 upon 2 into 1 plus F12 by 2. By this arbitrage argument, we can calculate the value of F12. Similarly, using the same argument, I can calculate the other values. Have a look at this. We can calculate, for example, F12 with this, or F23 using this S3 divided by 2 raised to the power 3, which is this, and S2 divided by 2 raised to the power 2, which is this. We can calculate F23. Similarly, we can calculate F34 using 1 plus S naught 4 divided by 2 raised to the power 4, which is this, S naught 4 divided by S naught 3, which is this, divided by 2 raised to the power 3, and so on. So we can keep on calculating and we can get the full forward rate term structure here. To summarize, in this video, we formalized the relationship between spot and forward rates. We also saw how to calculate from spot rates, how to generate the forward rate term structure. The underlying argument being the arbitrage argument that any deviations between or relative underpricing or overpricing between spot and forward would be corrected by arbitrage.